In the very first session, we talked about the need to do a bit of a business case to determine whether or not the project or the problem makes sense for you to undertake. And at that point in time, you're doing a pretty high level, kind of a rough and dirty kind of a business case. Now, as we've gathered the information we have over the last 6 sessions, as we've revisited the problem or the project again and again, we want to really start to take a better, deeper look into the business case of that, of the particular problem or project you're going to solve or you're going to deal with, I guess. Solving isn't probably the best way of saying it. So with that said, we probably will look at or in this session, we're going to look at the quantitative evaluation of the project first, knowing full well that qualitative considerations may be as important or even more important. So when we're looking at the quantitative evaluation of a project, what we probably want to do first is we want to map our cash flows from that project. And part of me thought, well, we could talk about financials and cash flows of projects before this session, or we could talk about them after. I mean, ultimately, by the time you go to start working on some of this stuff, you've gone through the different sessions. So I'll lay out the idea of the quantitative evaluation now, and we'll dig deeper into how to do that on a financial standpoint shortly. So within the quantitative evaluation, what you do, as I said, you're going to map out your cash flows. You're going to have an outlay of cash to begin with, and you'll probably even have an outlay of cash ongoing for a bit, whether it's paying for training, maybe it's even software that you have to pay for on a monthly basis, those types of things. Then from there, you're going to also map out the savings or the revenue that you're gaining from automating this. And those are really the direct benefits that we're going to get from automating our project. Once we've mapped out those gains to offset the costs, and I mean ultimately at some point those gains need to be offsetting the costs, otherwise we better have a really solid qualitative reason for doing this project. And I would just encourage you at that point to move on to that session. But hopefully you will find gains that will outweigh the costs of these projects. Now, how do we go ahead and map these gains against the costs, and how do we evaluate them based on if we have alternatives, or whether or not we even think it's worth it from a financial standpoint? Well, one of the easiest ones to do is a payback period. So after how many months, how many weeks, whatever the case might be, maybe it's years, but I'll put a caveat on that in a second. After how many weeks or months, we'll say at this point, has it taken for the project to pay back the costs of it? So when are we ahead in our gain that we're making from it? Now, payback period is wonderful because it's super quick. And quite honestly, it's probably one of the most used evaluation techniques going. I'll put the caveat on it though, is that it does not take into consideration time value of money. So you'll want to be careful in using it. I would say that if the project is going to be under 12 to 18 months, you could consider using payback period. But if it goes beyond that, you'll want to consider time value of money in it. So from payback period, you have a couple of additional options. You have a net present value and you have an internal rate of return calculation. And these are going to be done very similarly. So a net present value, we figure out what our weighted average cost of capital is for our company or our organization, which, I mean, if we're completely debt-based, it'll be basically our cost of debt. Most organizations aren't completely debt-based. They'll have some equity, and you'll want to put a kind of a price on your equity. So what's the value of your business growing by on a yearly basis? That's probably a quick way of figuring out roughly your cost of equity. Any dividends you're paying, you can add into that. And you weight that. If you're 30% equity and you're 70% debt, you take those corresponding costs and you weight them against each other. With that information, you come up with what your weighted average cost of capital is. And what you want to do is you take those cash flows that you've mapped, so those cash outlays and those gains, and you discount them. So if a gain is 3 years into the future, you're going to discount that for the 3 years by your weighted average cost of capital. You take all of those outlays and those gains or inflows, you discount them based on your cost of capital, and ideally, they're going to be greater than zero. If they're zero, then your internal rate of return is actually considered to be your weighted average cost of capital. If they're greater than zero, you're doing better than your weighted average cost of capital, and so that would mean that you'd want to undertake that project. So net present value is a handy tool. The challenge with net present value, there's a couple of challenges. Number one, if you're comparing a couple of projects against each other, it doesn't necessarily tell you which project is going to be a better percentage rate of return. Because net present value, just because something might have a higher net present value, doesn't necessarily mean it's a higher percentage. It might mean it's a bigger project or a longer term, whatever the case might be, or shorter term for that matter. So the other alternative is that you measure projects based on their internal rate of return. So what you do now is, and you'll need a financial calculator, or most people would do this in like a spreadsheet program to do it, but you'll lay out those cash flows and those and the gains that you're going to have. You're going to put in a discount factor. You're just not going to put that in yet, and you're going to add all those up and it equals zero. You're then going to solve for the discount factor. And once you've solved for that discount factor, that's going to be your internal rate of return. So instead of your net present value where you've put in your weighted average cost of capital, in your internal rate of return, you're actually solving for effectively your cost on that point. An internal rate of return is handy because now you've got a percentage of return on each of these projects. So that gives you a chance of being able to map these projects against each other and say, okay, well, this project has a 15% rate of return, this project has a 25% rate of return, and so forth. So again, I'm an advocate of using internal rate of return on my projects. I've generally mapped most things through Excel spreadsheets anyways with my cash flows and so forth, so it's not much actual extra work to figure out that internal rate of return. So that's normally my way to go, is figuring out what my rate of return on a project is and then looking at it from there. If I have a high enough rate of return, then I might look at different ways of possibly doing more than one project if I have enough resources available. But on a high rate of return project, it might make sense to bring in additional resources. After looking at our quantitative reasons for doing a project, we have to understand that there's a variety of other reasons why we might do a project. Particularly with automation of supply chain, or really any sort of automation or bringing in technology as a project, we need to consider a variety of factors as well qualitatively. Probably one of the first factors that we come across with, because we're talking about the idea of automation in the supply chain, is oftentimes the security of inputs. This is particularly true in southern Alberta, where we have things like weather getting into problems with delivery of components and so forth. So there might be reasons that although your project might not make sense from a rate of return standpoint or a payback period standpoint, it might still be a necessity in order to undertake this project so that you can secure your inputs for your organization, so that you can continue to meet your timelines on your selling of your outputs. So security of inputs is a major qualitative factor for implementing automation in the supply chain. And to the extent that security of inputs may end up costing you more money, you might not have a positive rate of return on undertaking a project that results in security of inputs. But if that means that you continue to be able to sell your product and meet your customer demands or meet growing demands, then there is the offset of increased revenue. The problem sometimes, though, is to quantify the revenue that we didn't get or that we didn't make the sale of. That never shows up on the financial statement. So that's something we have to consider. And we often talk, well, these are qualitative considerations. But I mean, the reality is that there is a quantitative aspect to that. An additional measure or reason why we might want to look at automation in the supply chain, and somewhat related to security of inputs, is the control of quality. There might be something that we're not getting a good quality product on or an input on, and we really need to make sure that that quality is there, especially when we're selling a high quality output. So sometimes by taking on a project that brings in-house our inputs, it helps us improve quality. There may also be additional automation projects, such as monitoring processes versus just inspecting things at the end, that are also about control of quality. And to begin with, this may look like a straight cost. So again, these might be projects that don't have a rate of return, or that we're just going to be outlaying cost. But there again, they could have a direct effect on revenue we eventually lose or we're not able to gain because of an image of our final project or product. So control of quality is another factor you want to consider as a qualitative evaluation within automating supply chain. One that's a little bit challenging to necessarily control the narrative around, but we need to, particularly it's important, is the employee morale. When we first talk about bringing in technology, we can often have a little bit of a decrease in employee morale because employees will see it as ways of being able to cut jobs, reduce the workforce, and so forth. So there might be some uncertainty. So good communication and transparency is needed as it relates to things around employee morale. But the reality is, from what I've generally seen, anytime I've brought in any level of technology into an organization, is that in due course, the employee morale actually increases because employees are able to shift their tasks to more meaningful work for them. And it allows the organization to grow. Most of the time, I don't see a direct decrease in labor costs by bringing in automation into the supply chain or any sort of technology. I do see an ability for the organization to grow at a faster rate and to upskill the employees and the labor force it currently has, which ends up being an increase in employee morale. But again, this one, lots of communication is required to have this come through properly for you. Also, it's another one that it's hard to necessarily put a number on it, especially given that some of your quantitative evaluations or your quantitative factors in your automation project may look at decrease of labor costs, though I would still caution against that because my bet is you're not necessarily going to see as much decrease in labor costs as you think you will to begin with, and you're oftentimes better off to hold your labor costs where they're at, if not even increase them a little bit to increase the resources you have, but look more so at the gain side of things. Finally, as we're talking about qualitative evaluations or qualitative considerations for automation projects, we want to look at the idea of protecting our intellectual property. So there's been times in my past where we've brought in-house the manufacturing of certain components or certain even tools back when we were involved in service companies, and we'd manufacture these tools or this equipment in-house because there were times that other competitors would get a hold of our designs from our manufacturers and start building them. So although this isn't directly related to the supply chain, it is in the sense of where we're getting our inputs from. With that, you want to consider that perhaps there's probably a consideration around the supplier you're using and that you might want to consider finding a better supplier. I'll put a note of caution on the idea of doing things in-house to protect intellectual property. I find it's oftentimes not in that organization's skill set. It's not their core competency, so they don't necessarily have a lot of business doing that kind of work. But I also understand the idea of protecting that intellectual property. I would encourage you to try to find a better vendor first, but if this is still a consideration for automating your supply chain, then that's fine. It's just one of those qualitative considerations that might be hard to quantify, at least in the near term. We can all take guesses as to what new intellectual property would be worth and what would be worth if we would lose it and not have that advantage, but it's one of those things you want to consider very carefully, and there are ways that you can try to protect yourself from having that intellectual property stolen. But again, it is a consideration for qualitative evaluations or qualitative factors after you've gone through the quantitative factors. All right, in the next session, we're going to start talking about what do we do with these kind of considerations. We've taken some time to look at the quantitative and the qualitative considerations and looking at evaluating a project. So let's take a minute to wrap that kind of conversation up. The first thing we want to consider is, are there any projects that are absolutely necessary right now for you to continue to be in business? Those projects are probably going to trump whatever other projects. There might be projects that are necessary for some of the qualitative considerations we had. There might be projects that are necessary from a cost-saving standpoint and so forth. So are there projects that relate immediately to your business survival? I would strongly consider taking those first. From there, when you have a few other projects, or even if you have one project and you're going back and forth on it, I encourage you to talk it over with other people. If you've got a couple other people within your organization, talk it over with them. If you've got some mentors or other peers or part of industry associations or anything like that, talk over the project with other people. Try to get different input, different considerations within the project. I've said it before, and I'll say it again here, I strongly encourage against more than one project at a time. Now, that means if you happen to have a choice between a quick project and a long project, you might want to do the quick project first. It's a good warm-up project. You get it underway or you get it out of the way, and then you can focus on the longer project. But again, I encourage you to take on one project at a time, as that gets at kind of my final point on this, is you have to be able to focus and commit on that particular project. And not only just yourself, even though you're probably one of the busier people in your organization, if you happen to be the owner or the president or hold an executive role in the organization, but it's also going to take time away from different people at your organization. So really consider if you can commit for that project. And generally getting buy-in from people that are going to have to spend some time on the project, getting buy-in before you commit, getting buy-in on the actual evaluation of the decision to take on the project, that will go a long way in getting that commitment out of other people as well. So hopefully you're clear now on the project that you're going to undertake. Now let's talk a little bit about financial statements. When do you do the financial statements, or when do you work on the financial statements? I've mentioned it before, but what you've probably already done, you probably have a sketch of what this particular project will mean from a financial statement standpoint. So what will it mean in terms of revenues or expenses? What will it mean in terms of outlays of cash in order to undertake the project? So this is a little bit of an iterative process. Again, you've probably gone back and forth throughout this as you're looking at the different projects. So what you'll end up wanting to do, especially if you're going to a different audience or an external audience like a bank or a funding source or other funding sources, you'll want to do up a set of financial statements that take into consideration project implementation and those that would happen without the project. You probably already have the projected financial statements based on not having the project, but now you'll want to add the project into those financial statements. This session I'm going to cover off some of the basics in putting together these kinds of projected financial statements. and then implementing or putting the project into it as well. One of the things that I see a lot of within financial statements or projections is a missing component of the assumptions. It's very important that you list the assumptions that you're making within these financial statements. So what are you assuming relates to the revenue? What kinds of things have gone into those considerations? A lot of times that'll come out of your forecasting that you did, that we talked about earlier on. But if, for example, you're within the oil and gas industry and you're expecting your major customers to go up by 30% in your revenue, you should support that with something. Are the drilling forecasts showing a 30% increase? Have they raised their capital budgets? So try to support any of the assumptions you're making. So first and foremost, list the assumptions you're making, and then second, try to support the assumptions you're making. And the stronger or the better job you do of supporting those assumptions and listing out the assumptions, the more credible your financial statements are going to look. So once you've gone through, you figured out your assumptions, and you're going to do this almost line by line as it relates to the income statement and the statement of financial position or balance sheet. You'll then want to start actually assembling these different financial statements. For the income statement, you're going to have revenue, and you might have that as one line, or you might have that as several lines, because you might have different streams of revenue. You might have sales revenue, service revenue, rental revenue, whatever the case might be. And you may even break that down further, partly depending on the project you're implementing. From sales, you're going to have cost of goods sold. Those should be lined up with the particular lines of your revenue. That would be the ideal situation. Oftentimes they'll have a small fixed component, but oftentimes they'll be based largely on a percentage of revenue. You know that your direct labor costs are 30% of your revenue, for example. But you also know that there's a certain amount of it that you're just going to have anyways. So you might throw in $10,000 a month plus 30% of revenue or something like that. After your cost of goods sold, you'd have your gross margin. That's your revenue less your cost of goods sold. Then from there, you have your overhead costs and your general operating costs. They're going to include things like your office, your administrative and your management wages. They're going to include utilities, office supplies, insurance, a variety of different costs. Amortization will be in there, but that's a representation of the economic value decreasing in your assets. Your interest on a debt will be in there as well. So those will form your financial statements. Those will form your income statement. Again, though, you want to have an income statement that is with the project and one that's without. You may also want to show a good case scenario or a best case scenario and a worst case scenario set of financials. With your income statement nearly done, you'll also want to build a statement of financial position, also known as a balance sheet. And this includes your assets and your liabilities and your equity as well. Your equity will be partly derived from your share capital, and it'll be partly derived from what your income statement is showing on a month-by-month basis. So your balance sheet should also be done in two versions, one without the project and one with the project. And again, clearly articulate what the difference is because of the project. And likely there might be an increase in an asset value, there might be an increase in a liability value as well. There might be an increase in equity that goes in because you're contributing some cash to the project. So you have your income statement and your statement of financial position. One thing to consider is that you probably want to do the next 12 to 18 months as monthly financials, and then from there you probably want to build out 3 to 5 years into yearly financials as well. And that's going to be dependent a little bit on the project you're undertaking, and it's going to be dependent a little bit on the terms of the funding that you're going to undertake with the project as well. That said, if you're doing a new building that is going to be heavily automated and you're going to look for a mortgage on that building of 20 years, you don't need to stretch out projected financial statements for 20 years. Once you have the income statement and the financial position done, or the balance sheet done, you want to look at a cash flow statement. Now, a lot of banks don't necessarily require a formalized cash flow statement, but one of the things that you definitely want to do as it relates to external audiences will be to come up with a statement of uses and a statement of sources of those funds. And both of those columns should equal at the end of the day. And if you're going to need working capital as one of your uses of funds, explicitly state that. We need 6 months of working capital at an estimated $30,000 a month. We need $180,000 in working capital, whatever the case might be. A note on that, working capital is often quite difficult to fund unless you have extra security within your organization somewhere else. But we'll get into that in a little bit.